and it's about not only small, medium-sized enterprises, but also micro. So micro, small, and medium-sized enterprises even smaller. So the topic, as you can see, that is about micro, small, and medium-sized enterprises financing problem, and this is a classical corporate finance topic, and they are going to make the connection between financial inclusion, which I think is a very popular issue right now, particularly for those vulnerable smaller firms. And then it is based on, I have not heard of this data set before. It's a survey based on the Chinese, the survey data of Chinese very small enterprises. So very relevant topic to us. So let me first of all introduce the presenter. And Miao is the final year PhD candidate at the International Business School Suzhou, which is a part of Xi'an Jiaotong-Liverpool University. And I now gradually know much more about this university. It is very big, joint venture university between the UK, between Liverpool University and China. So Miao's research research interest, the research area covers different subtopics such as financial inclusion, small and medium-sized enterprises, and land reform. So I would save some time by not introducing all other co-authors, but we have Miao as the presenter today for this paper. I'm very curious about the paper. So Miao, are you ready?
Yes, I'm ready.
Yeah. Do you mind? You are going to turn on? Yes, please. So so the floor is yours. Just take it as a conversation, informal. It's not that formal, to be honest. So that you just have a discussion with the audience and then see whether we have some good questions and comments.
Thank you. Thank you.
Okay, welcome.
Thank you very much. Okay. So good afternoon, everyone. I'm Miao He from Xi'an Jiaotong-Liverpool University in China. Thank you for inviting me and giving me this opportunity to present my paper in this seminar. Today, my topic is to what extent does financial inclusion affect the Chinese MSMEs performance? The abbreviation MSMEs here is the total of micro, small, and medium-sized enterprises. First, I will introduce the background. MSMEs play crucial roles in achieving the Sustainable Development Goals of the United Nations. They contribute to sustainable economic growth, employment, industrialization, innovation, and reducing income inequalities, especially in developing countries. The statistics in China also show that MSMEs make great contributions to the national economy in terms of GDP, tax, employment, and innovation. However, MSMEs often face severe financial constraints that inhibit their development, especially those in developing countries. Financial inclusion aims to solve their financing difficulties, and financial inclusion for MSMEs in this study is defined as firms have a line of credit from a formal financial institution. Financial inclusion in this paper is also called formal finance or bank finance. And it's well documented that the access to formal finance is positively associated with firm performance. According to the catch-up or convergence effects, firms that are more financially excluded may benefit more from financial inclusion. Existing literature also shows that the firms with different attributes show different levels of financial inclusion. This implies that the impact of financial inclusion differs for firms with different characteristics. However, to our knowledge, studies on the heterogeneous effects of access to formal finance on firm performance for MSMEs with different attributes are limited. So our research question is, to what extent does financial inclusion affect the Chinese MSMEs performance? And we choose China as the research setting, first because compared with other developed economies, Chinese MSMEs suffer from greater financial constraints due to its weak institutions, particularly the weak protection of property rights. In addition, the financial technology in China has developed rapidly in recent years, which greatly improves MSMEs' access to formal finance. Owing to the adoption of digital technologies such as artificial intelligence, big data analysis, and cloud computing, it is easier for banks to collect and analyze business information and firm characteristics. As a result, the information asymmetry between MSMEs and banks can be effectively mitigated, thereby improving their credit accessibility. On the other hand, the Chinese government has launched a series of financial inclusion policies to promote firms' use of bank finance. Due to the policy-driven lending behavior of Chinese banks, they are obligated to issue loans to certain groups to serve their political goals. So some Chinese firms may benefit from preferential treatment in the usage of bank finance. And meanwhile, because China is the largest developing country, the conclusions drawn from the Chinese experience might be generalized to other developing countries. Then come to the contributions of this paper. First, it adds to the literature on the importance of bank financing for firm growth and performance. The existing literature has shown that bank financing plays an essential role in firm development, especially for the informationally opaque MSMEs. Even though existing studies show that the impact of bank financing on MSMEs' performance varies with firm-specific attributes, including their firm age and the industry, other dimensions that may influence the bank financing and performance relationship are rarely explored in the literature. So in this study, apart from the firm-specific attributes, we also assess the extent to which firm owners' attributes and province attributes exhibit different sensitivities of firm performance to the availability of bank finance. Second, our paper contributes to the literature that shows the heterogeneous impact of financial access or financial constraints on firm development. The literature has shown that the impact of improved financial access on firm performance differs with firm size, owner's gender, owner's financial literacy, and focusing on internal financial constraints and the credit constraints. Existing studies have tested the moderating roles of ownership, liquidity, exporting status, firm size, coastal or inner regions, political connections, organization structure, and firm age. In contrast to these papers, we highlight some unique Chinese characteristics, which are important to policymakers, and investigate some additional moderating effects, including the firm's attributes, including the location, that is, whether they belong to rural or urban regions, high-tech attributes, the distance to the high-speed railway station, and the firm's listing status, owner's attribute, that is, owner's education, and province attribute, that is, provincial economic development. Third, they study extend existing literature by showing the substitution or complementary effects of formal financing and other financing channels. The existing studies have shown that when formal financial system is less efficient, informal financing plays a significant role in firm growth. However, these papers do not consider digital financing, which is an important type of financing in China in recent years. This study contributes to the literature by adding evidence on the substitution and the complementary effects of formal financing and the other financing channels, including digital financing and informal financing. Then I will introduce the Chinese financial system. The banking industry is the most important part of China's formal financial system. Most bank loans in China are backed by collateral, and the only type of collateral acceptable to many banks is land or buildings. The banks rely on courts and local governments for reproducing collateral and to ensure no repayment. Banking sector includes state-owned commercial banks, joint stock commercial banks, rural credit cooperatives, and so on. Second, digital finance refers to the finance provided by the information and communication technologies. ICT companies such as Alibaba, Tencent, and the Jingdong Group in China. Digital finance plays an increasingly important role in China's financial system, especially in recent years. Then the informal financial sector in China, also regarded as the non-standard financial sector, comprises pawnbrokers, loan sharks, relatives, and friends. Different from banks, the informal lenders rely on trust and reputation or coercion and violence for repayment of the loans and often do not require collateral or guarantees. Next is a theoretical framework. Information asymmetry theory and the law of diminishing marginal returns are two basic theories in this study. Information asymmetry theory indicates that information asymmetries exist between banks and firms, which definitely affects firms' access to bank finance. Here, the law of diminishing marginal returns, which is also similar to the catch-up or convergence effect, indicate that when one additional financial capital is used by the firm, the increase in output will diminish gradually. Therefore, for the initially more financially constrained firms with additional financial capital input, the returns to capital are higher compared to the less financially constrained firms. And the single-loan theory argues that firms would single their relevant characteristics to banks to show their quality, so that the information asymmetries between firms and banks can be mitigated to some extent. The government intervention theory suggests that government intervention plays an essential role in redistributing the resources. From the government intervention theory, we know that in China, to better allocate the financial resources, a series of financial inclusion policies are launched, and thus firms may be subject to different levels of government intervention. As a result, some firms may benefit from the preferential treatment in using bank loans. The institutional theory suggests that the financial constraint for small businesses is an important consequence of institutional voids. And the last is the resource-based theory, which indicates that better human capital of the firm allows greater viability of the firm and the success. So better human capital acts as a singular of superior quality of the firm, and the credit suppliers such as banks are likely to lend to these firms. And consistent with prior studies, we argue that formal financing empowers firms with sufficient cash resources and capabilities, which provides the financial support for investment that promote firm development. Hence, we propose the general hypothesis that is financial inclusion has a positive impact on firm performance for Chinese MSMEs. The interesting part is the hypothesis on firm heterogeneity. The first dimension is related to firm-specific attributes. The Chinese government highlighted the importance of rural development and the three rural issues. To resolve the three rural issues, a series of preferential financial inclusion policies targeted at the rural areas are implemented. This government intervention motivates us to explore the differential impact of financial inclusion on firm performance for rural and urban MSMEs. Because firms in rural areas may benefit from the preferential treatment due to these policies, so they are more financially included. In contrast, MSMEs in urban regions may be severely financially constrained due to high competition for limited pool of funds. Therefore, according to the law of diminishing marginal returns, we believe that urban MSMEs will benefit more from improved access to credit. So the second hypothesis is the positive impact of financial inclusion on firm performance is more pronounced for urban MSMEs relative to rural ones. Likewise, considering the significance of high-tech firms and their financial constraints, Chinese governments have launched various financial inclusion policies to alleviate high-tech firms' financing difficulties. This government intervention also motivates us to explore the differential impact of financial inclusion for high-tech and non-high-tech MSMEs. Due to the policy-driven lending behavior of Chinese banks, high-tech firms could benefit from the preferential treatment in the usage of bank finance, thereby being more financially included. But the low-tech MSMEs might suffer from substantial financial constraints due to high competition for limited pool of funds. So in this case, the more financially constrained firms, that is the low-tech MSMEs in our case, should have better performance with improved credit access. As one of the most advanced ground transportation modes, high-speed railway has greatly changed the regional economic distribution patterns, resource allocation, and industrial structure in China, and may also influence the lending behavior of banks. So it is worthwhile to investigate how firms' distance to the nearest high-speed railway station matters in the impact of access to credit on firm performance. Because the high-speed rail has reduced the time distance between firms and banks, if firms are closer to the high-speed railway station, it is more convenient for banks to interact with firm managers so as to obtain the private information of firms and reduce information asymmetries. But the distant firms are less likely to obtain banknotes due to high information asymmetries, so the positive impact of financial inclusion on firm performance is more pronounced for MSMEs that are farther away from the high-speed railway station. Then considering the development of China's multi-tier financial market, in particular, the SMEs can list on the SME board or for equity financing, and some MSMEs can engage in equity financing in the National Equities Exchange and Quotations, also called NEQ or Neutral Board in China. We further argue that the impact of financial inclusion on firm performance may vary between listed SMEs, NEQ firms, and unlisted firms. Listed firms and NEQ firms needed to conform to certain listing rules and the requirement of information disclosure, which actually means that they have less information asymmetry, and thus listed firms and NEQ firms are more likely to be financially included. But the unlisted firms are more informationally opaque because their information disclosure is limited. So the unlisted MSMEs are more likely to be financially excluded from formal financing channels. Therefore, we argue that the effect of financial inclusion may be stronger in terms of unlisted firms' performance than listed firms. The related hypothesis is the positive impact of financial inclusion on firm performance is more pronounced for unlisted MSMEs compared to the listed ones. And the previous study have shown that firm owners' human capital significantly affects firms' access to formal credit. We then tested the moderating role of owners' human capital in the finance and performance relationship. Because owners' education is an important aspect of firms' human capital, we then look at the moderating effect of owners' education in particular. According to the resource-based theory, better human capital of the company allows the greater viability of the firm and their success. Hence, better human capital acts as a signaler of superior quality of the firm, and the credit suppliers, here the banks, are likely to lend to these firms with greater growth prospect. So MSMEs with better educated owners may have higher probabilities of obtaining bank loans, and thus they will benefit less from financial inclusion. So the related hypothesis, the positive impact of financial inclusion on firm performance is weaker for MSMEs whose owners are better educated. The last dimension is related to provenance characteristic. Many studies have explored the link between the regional economic development and firms' access to finance, but whether regional economic development moderates the effect of firms' access to bank finance on their performance is unclear. So that we will focus on the moderating role of economic development in this study. It is well documented that firms in regions with better economic development have higher probabilities of accessing bank finance, as richer regions tend to have better institutions. So because the weak institutions may exacerbate the financing difficulties of MSMEs, MSMEs in regions with lower economic development are more financially constrained, so they will benefit more from financial inclusion. The related hypothesis, the positive impact of financial inclusion on firm performance is stronger for MSMEs in regions where the economic development is lower. Then let's look at my research design. Here we use a unique survey data set for Chinese MSMEs. In this study, we use the 1 year data, the year 2021's information. So this is the cross-sectional data set. And the survey covers 29 provinces in China. The firms are randomly selected from the agriculture, manufacturing, and service industries. To be representative across regions and industries, we adopt a stratified random sampling method. There are 5 sections in the survey questionnaire, including the general information about the firm, including firm age, firm size, legal status, ownership, and etc. The use of bank finance, including no amount, no cost, and no adequacy, and the firm's financial information, that is their sales, profits, and so on. And the owner's information, including owner's age, their education, and the business experience. As shown in this pie chart, we found about 40% of the sample use bank loans, while about 60% of the sample do not use bank loans. So for the non-bank financed firms, the survey further asks, does your company need bank loans or not? And the leading reason is do not need bank loans. Regarding firms that report they do not need bank loans, the survey further asks, why does your company not need bank loans? And the answers are shown in this figure. So we can see that the firms have sufficient internal funds and that do not need external financing is cited as the most important reason for not needing bank loans. This implies that most non-bank financed MSMEs in our sample are not financially constrained, and their primary funding source is their return earnings. In addition, while 199 firms choose to borrow from their relatives, only 17 firms choose to borrow from informal financial institutions. Both the financing from relatives and the financing from informal financial institutions belong to informal financing. The results here demonstrate that informal financing is a substitute for formal financing. And more importantly, MSMEs prefer borrowing from relatives than informal institutions because informal institutions often charge higher interest rates or fees than relatives. And it can be noted that 116 firms indicate that they do not need bank loans because they finance from online platforms, which implies that the internet financing is also the substitute for formal financing. In my sample, 88 firms use trade credit, as indicated by Yang et al. 2020. Trade credit substitutes for banknotes in promoting the development of Chinese SMEs. And even though Chinese MSMEs can be listed on the SME board and the user board, they all trade their equity in the regional equity exchanges. Only 3 firms in my sample report that they use equity financing. This is actually in line with the findings of NIET or 2019, who show that the debt financing is still the main source of external financing for Chinese MSMEs. And for the bank financed firms, the survey further collects information on the source of banknotes. As suggested in this figure, most firms use loans from state-owned banks. Our results indicate that state-owned banks are the primary fund providers for Chinese MSMEs. This may be because state-owned banks are more policy-driven, and they should have made a great effort to realize financial inclusion towards MSMEs. And here, this graph shows the sample distribution. Because our sample include micro, small, and medium-sized enterprises, we then look at the sample by firm size. As shown in this pie chart in the top left column, the small firms take up the largest proportion, about 49%. Medium-sized firms and the micro firms have similar percentages, with 28 and 23% respectively. When we look at the bar chart in the bottom left column, it is interesting to find that about 54% of micro firms use banknotes. This is a relatively large percentage because there are only 40% bank financed firms in the whole sample. Our statistics suggest that the coverage of banknotes for micro firms improves compared with the estimate by the China Banking and Insurance Regulatory Commission in 2012, which shows that nearly no loan for micro enterprises. This significant improvement may be because the financial inclusion policies target MSMEs. For example, the government financing guarantee institutions to promote MSMEs bank financing. Also, because we pay attention to the differential impact of financial inclusion for rural and urban firms, we then look at the sample distribution based on this firm attribute and hope to gain some insight. According to this pie chart in the top right column, urban firms accounting for 56% of the whole sample and are more than rural firms, which only make up 44% of the whole sample. It is interesting to note that almost 47% rural firms use bank finance, while only 34% urban firms use bank finance. Our statistics indicate that MSMEs in rural areas can easily access bank finance, which may be due to the widespread rural microfinance institutions, the development of the financial technologies in China, and the financial inclusion policies for rural areas. Then this table shows the variables used in this study. Firm sale and profit before tax are 2 firm performance indicators. Because our survey only provides information on the range of sales or profit before tax instead of the actual amount, we use the midpoint of the corresponding sale or profit before tax range to represent firm's sales or profit before tax. So the firm's sale or profit before tax is measured as the logarithm of 1 plus the midpoint of the sale or profit before tax range. Our independent variable is financial inclusion dummy, which equals 1 if the firm has a banknote outstanding at the end of 2021. It can be noted that the informal finance is also a dummy variable that equals 1 if the firm has an informal note outstanding at the end of 2021, and the DFI is the Digital Financial Inclusion Index at the provincial level. This data is collected from the Peking University Digital Financial Inclusion Center. And this table shows the descriptive statistics. It can be noted that the first, bank financed MSMEs earn an average of 20 million RMB sales in 2021. In contrast, the non-bank financed MSMEs only earn 15 million RMB, significantly lower than that of the bank financed MSMEs. This pattern still holds for profit before tax. That is, the bank financed MSMEs have higher profit before tax than non-bank financed ones. Second, more than half of the bank financed MSMEs are located in rural areas in our sample. This may be due to the preferential policies for rural firms in recent years. This also echoes our sample description. Third, the difference in the distance to nearest high-speed railway station between bank financed and non-bank financed MSMEs is also significant, indicating that bank financed MSMEs are closer to the nearest high-speed railway station than non-bank financed one. This fact supports the findings of previous studies that the high-speed rail can promote proximity between firms and banks, thereby mitigating their degrees of information asymmetry of firms and improving their access to bank finance. Moreover, the bank financed MSMEs are located in regions with higher levels of banking development, which suggests that the regional banking development is associated with improved credit access for local MSMEs. Here, the descriptive statistics provide some preliminary evidence that bank financed MSMEs have better performance than non-bank financed ones. I will estimate the causal impact of bank financing on firm performance in the empirical section. We also look at the correlations of some key variables. Also consistent with our sample descriptions, both the internet finance and the informal finance can substitute for bank finance. We will also investigate the substitution or complementary effects of formal financing and other types of financing in supporting Chinese SMEs development in our empirical section. And this part shows the models and the methodology. This equation is to test the impact of financial inclusion on firm performance. In order to test the heterogeneous effects, subsample regressions are used. Then we aim to explore the impact of explore whether formal and informal financing are complements or substitutes in terms of their role in boosting firm development. Following Ayagari et al. 2010, we estimate the following model. The independent variable here is the informal finance domain, and to test the substitution or complementary effect of formal financing and digital financing, we follow Allen et al. 2019 and include financial inclusion domain, the provincial digital financial inclusion index, and their interaction term in the model. Here, I is the firm and K is the province. The key identification challenge is the potential endogeneity problem, because it is also possible that firms with better performance are more likely to obtain banknotes. To address this issue, we use the instrumental variable approach. We follow Allen et al. 2012, who use the amount of bank credit per firm in a state as the instrument to investigate the impact of firm-level access to bank finance on firm growth for Indian firms. We also identify an instrumental variable, that is the average amount of bank credit per firm in a province, measured as the total amount of bank credit supplied by local banks divided by the total number of local corporations in a province. This credit supply variable is positively related to firms' access to bank finance, but it is not directly linked to higher performance because firm performance should be determined by factors such as the operations of the firm and market demand conditions. We employ the two-stage Gini square for estimation and report the results in following. This table shows the baseline results. We can look at this table. The first stage shows that the regional development in bank financing significantly increases the probabilities of being financially included among MSMEs. This is also in line with our descriptive statistics that show regional banking development is associated with improved credit access for local MSMEs. In addition, the F statistics of the weak identification test are above the reference value 10, indicating that the instrument is valid. Then the second stage shows that financial inclusion has a positive impact on firm sale, which supports our hypothesis 1. If firm performance is measured as profit before tax, the results still hold. And the following tables shows the heterogeneous effects based on subsample regressions. The first one shows the heterogeneous effects of financial inclusion on firm performance for rural and urban MSMEs respectively. We found the F statistics are above 10 only in the urban subsample, indicating that the IV is valid only in the urban subsample, not in the rural one. So we will use OAS to estimate the correlations for rural firms. We found that financial inclusion improves firm sales by improves firm sales by 106 to 125% for urban firms, and it is associated with about 10 to 11% increase in sales for rural firms. So the increase in sales for rural firms is less than that for urban ones, which exactly supports our H2. This is because the rural MSMEs are less financially constrained because they can enjoy the preferential treatment due to the financial inclusion policies. But the urban MSMEs are relatively more financially constrained, so urban firms can benefit more from financial inclusion. And this table shows the moderating effect of firms' high-tech attributes. Still, the IV is only valid for the low-tech subsample, not for the high-tech one. I also use OAS to estimate the correlations for the high-tech MSMEs. Comparing the two-stage Gini square and the OAS estimates, we observe that the effect of the of financial inclusion on firm performance is stronger for low-tech MSMEs relative to high-tech ones. So H3 is supported. And this is because the high-tech firms benefit from the preferential treatment due to the financial inclusion policies. So high-tech MSMEs are more financially included. Therefore, the impact of financial inclusion on firm performance is weaker for them. Then we tested the moderating effect of the distance to the nearest high-speed railway station. To do so, we divided the sample based on the median level of the distance. We found that the IV is valid only for firms that are farther away from the high-speed railway station. Following the same procedure, I only report the correlations using OAS estimator for firms that are closer to the high-speed railway station. And the two-stage Gini square estimates shows financial inclusion improves firm sales, firm performance for firms that are farther away from the high-speed railway station. But the OAS estimates indicate that the financial inclusion is negatively correlated with firm performance for firms that are closer to the high-speed railway station. So H4 is supported. Because the information asymmetries are higher for distant firms, they are more financially constrained, so they will benefit more from financial inclusion. But here, it is unexpected that the use of bank credit is negatively correlated with firm performance for MSMEs that are closer to the high-speed railway station. This may be due to the policy-driven lending behavior of China's banks. The banks are required to lend to MSMEs to serve their political goals. So some MSMEs may obtain banknotes even if they do not need them. Firms with additional banknotes tend to overinvest, which may hurt the firm's investment efficiency and reduce their performance. And this table presents the two-stage square estimates for listed and unlisted MSMEs. Still, the two-stage square is biased for the listing firm subsample. From the two-stage square results, we found the use of bank finance improves the firm's performance for unlisted MSMEs. But the OIS results show that the financial inclusion is not related to firm performance for listed ones. So our H5 is confirmed. This is because the unlisted MSMEs have higher information asymmetries because they have limited information disclosure. So they are more financially constrained and will benefit more from financial inclusion. Then comes to the owner-specific attributes, that is the owner's education. In this case, we divide the sample based on the mean level of owner's education. This is because if we divide the sample based on the median level, the number of firms whose owners have higher education level is only 31. To ensure the sufficient number in each subgroup, we use the mean level of education instead of the median level. From this table, we can see that the two-stage square is biased for MSMEs with better educated owners. So we use OIS to estimate the correlations for this subsample. According to these two tables, we know the positive impact of financial inclusion is stronger for firms whose owners are worse educated. So H6 is supported. This is because firm owners with higher education are more likely to manage their firms well, and this is a signal of good quality of the firm. So firms will have better credit accessibility, hence they will benefit less from financial inclusion. Last, we focus on the moderating effect of provincial economic development. Similar to previous moderating effects, the two-stage square is still biased for one subgroup, that is MSMEs in regions with higher economic development. The two-stage square estimates show that financial inclusion positively affects firm performance for MSMEs in regions with lower economic development, while the OIS estimates show that financial inclusion is negatively related to firm performance for MSMEs in regions with higher economic development. So H7 is supported. This is because firms in regions with lower economic development are more financially constrained, and thus they will benefit more from financial inclusion. Also, the negative association for firms in regions with better economy may be because of the policy-driven lending behavior of China's banks. The banks are required to lend to local MSMEs to serve their political goals. So some MSMEs may obtain banknotes even if they do not need the notes. Firms with additional banknotes tend to overinvest, which ultimately harms their performance. And we can see that all the heterogeneous effects results confirm the convergence effects. We also conduct some additional analysis in the following. Because Chinese micro firms are mostly privately owned and registered as household-based enterprises, the behavior of micro enterprises is essentially different from that of SMEs. More importantly, micro enterprises account for the largest proportion of Chinese MSMEs. So we further explore the differential impact of bank financing on firm performance for SMEs and micro enterprises respectively. From this table, we can see that the use of bank finance improves SME sales, and the F statistics are greater than 10. However, with regard to the micro enterprises, the F statistics are below 10, implying that the two-stage least square coefficient is biased. Instead, we rely on OIS estimates to look at their correlations, the correlations between financial inclusion and firm performance for micro firms. The results here suggest that financial inclusion has low significant effect on firm performance for micro enterprises. Here for micro firms, because due to their lack of capacity, they are concerned about the potential bankruptcy risk, and that they are less likely to use formal loans to invest in high payoff projects, especially after the COVID-19 pandemic. Under the poor investment environment, even though micro enterprises have additional bank loans, they do not use the loans to fund investment because it is likely that the investment would fail. Instead, some micro enterprises only use the loans for subsistence purposes. For example, the bank loans may be used to supplement the cash flows to maintain firms' operations. Therefore, the use of bank finance may not enhance micro firms' performance, and the positive financial inclusion effect is driven by SMEs instead of micro firms. Then we investigate the substitution or complementary effects of formal financing and other types of financing in supporting Chinese MSMEs development. As we only investigate the relationship between informal financing and firm performance instead of the causal impact, we use OIS to estimate the equations. It can be noted that for micro enterprises, informal financing does have a significant and positive relationship with firm performance. The result is consistent with the findings of Beck et al. 2015, who also demonstrate that it is informal financing instead of formal financing positively affects firm performance for micro enterprises in rural China. Different from formal financing, the enforcement of informal loans is not through the legal system, but through trust, reputation, and relationship instead. Micro enterprises are thus less concerned about the bankruptcy risk arising from informal loans. Accordingly, informal financing provides micro firms with financial support to fund investment, which contribute to better firm performance. Our findings imply that the informal financing substitutes for formal financing in promoting the development of Chinese micro enterprises. We then test the relationship between formal financing and digital financing. After trying the IV method, we cannot find a suitable IV in this case, so we still use OIS to estimate the relationships. As can be seen from this table, first for SMEs, while both formal loans and the digital financing can are positively associated with firm performance, their interactive role is negative. This implies that formal financing can effectively promote firm development when local digital financial system is less developed. Therefore, formal financing and digital financing are substitutes in supporting SMEs development. Second, for micro enterprises, while the coefficient of formal finance is insignificant, the coefficient of the interaction term is positive and significant. This suggests that the bank financing is more effective in promoting micro firms' performance in provinces with better digital financial systems. Thus, digital financing exerts the complementary role for formal financing in promoting firm performance for micro enterprises. The results are robust when firm performance is measured as profit before tax. Further, we distinguish between different sources of formal finance to study whether they have similar effects. We divide banknotes into those from private banks, that is joint stock banks, city commercial banks, credit cooperatives, and other private banks, and those from state-owned banks to investigate the heterogeneous impact. We first tried the IV method, but we failed to find a suitable IV in this case, so we use OAS to estimate the relationships instead of the causal impact. We can see the table here. For SMEs, firms using notes from state-owned banks are associated with about 29% higher sales. Higher sales than firms without formal financing, and it is significant at 1%. In contrast, the SMEs using notes from private banks are associated with about 38% higher sales, which is also significant at 1%. So our results indicate that the private banks are more efficient than state-owned banks to promoting the development of Chinese SMEs. To some extent, our results are consistent with the findings of Chong et al. 2013, who suggest that private banks are more efficient in alleviating the credit constraint of Chinese SMEs. Regarding microenterprises, our results show that formal finance, no matter where the funds come from, is not effective to promote microenterprises development. The results here confirm our previous findings that the use of formal finance has no impact on firm performance for microenterprises. Then I will discuss the results and provide some policy implications from the heterogeneous effects. Heterogeneous effects of the location. We find that Chinese rural MSMEs no longer face substantial obstacles in the access to bank finance. The findings suggest the effectiveness of China's rural financial inclusion policies. Rural MSMEs with improved credit access are able to perform better and grow faster, thereby facilitating rural development and reducing the rural-urban gap. But in the current stage, as urban MSMEs tended to benefit more from financial inclusion, as shown in our study, so that means the urban MSMEs are more efficient and more financially constrained. So more banknotes should be allocated to the more efficient ones to improve the allocation efficiency. So from this perspective, governments and banks should consider the reallocation of financial resources to urban MSMEs so as to improve the resource allocation efficiency. And similarly, the heterogeneous effects results regarding the high-tech attributes suggest that the high-tech MSMEs are less financially constrained because they can enjoy the preferential treatment in using banknotes. Here, our findings prove the effectiveness of recent financial inclusion policies target at the high-tech firms in China. High-tech MSMEs that have improved credit access tend to have better performance, hence facilitating the long-run economic development. On the other hand, as the performance of low-tech MSMEs benefits more from financial inclusion than high-tech ones, as shown in our study, governments and banks should pay more attention to alleviating the financial difficulties faced by low-tech MSMEs, thereby realizing the convergence in economic growth. In addition, the government and banks should pay attention to the disadvantaged groups, including MSMEs that are farther away from the high-speed railway station, and MSMEs with worse educated owners, and in regions with lower economic development, and allocate credit to them, which is conducive to promoting convergence in growth across different firms, and in turn contribute to the development of the whole economy. Next, as informal financing plays an essential role in the success of micro enterprises, the Chinese government should adopt suitable enhancing regulations for informal financial market, thereby supporting the growth of micro enterprises. And the different financing channels can work together to alleviate firms' financial constraints and facilitate their development. Accordingly, the inclusive financial system could incorporate digital financing and informal financing. Then I will show you the conclusions of our paper. Overall, the financial inclusion can facilitate firm performance for Chinese MSMEs. From the heterogeneous effects analysis, we found that the more financially excluded firms tended to benefit more from financial inclusion. That is, their performance increases more due to the improved credit access, which supports the catch-up or convergence effect. Our paper also suggests that the positive financial inclusion effect is driven by SMEs instead of micro firms, and the informal financing has a significant and positive relationship with firm performance for micro firms. The formal financing and digital financing are substitutes in supporting SMEs development, while they are complement for micro enterprises. Okay, that's all about our paper. Thank you for your listening. I really appreciate your questions and comments. Thank you.
Okay, thank you, Miao. You worked very hard, and I think paper covers quite a lot of things. It's quite, from different aspects. So I'm sure there are, for people who are interested in this topic, I think we will have different views on the issues that you have touched upon. So I do not see any hands at the moment. Colleagues, do you have any questions? If you can raise your hands so that I know. I wonder, I see one hand. Oh, Jaideep. Hi, Jaideep. Please, yeah. So Jaideep is one of the colleagues in the same department. I'm sure, Jaideep, you will. Oh, yeah.
Thanks, Hong. Thanks, Miao.
Miao,
very interesting presentation.
Would you like to maybe close your transparency?
Oh, okay.
Yeah, thank you very much. Yeah.
Yeah, so I have like a really initial question at first. Basically, I'm trying to figure out this understanding of financial inclusion that you refer to. I mean, you refer to financial inclusion, then you talk about financial access, and then you use bank lending as a proxy for it. But in all cases, I mean, it's not clear to me based on your survey results that it's actually access that is the factor. Like, in equilibrium, there are many firms that seem to have access that choose not to borrow from banks based on your survey findings. So is it the case that you're picking up the fact that banks are really good at picking better performing firms, or is it the other way around? I know you do this 2SLS stuff, but I think I'm just kind of trying to understand why you're going on the financial inclusion angle, where it's very difficult to see that there's any kind of change in access.
Yeah, we collect the data, survey data from the demand side. We directly ask the survey company and ask them whether they have bank loans. So yeah.
Yeah, but can you elaborate a little bit further about why bank loans are used as an indicator of financial inclusion?
Because the financial, based on the definition of financial inclusion is to ensure ensure every individual to have the access to widespread basic financial service, and for MSMEs their basic financial service could be the bank credit. And also banking sector is dominant in China's financial system. So that's why we choose bank credit as the basic financial service, and choose the access to bank credit as their financial inclusion indicator.
Yeah, so that's basically the reason for my question, is because you're talking about demand side,
Yes.
As opposed to supply. So the measure of access is a supply side measure, but you've asked demand side individuals whether they have bank loans or not, and many of them, a very significant proportion of them, have said they don't want them. So this is my question. So that is the reason this notion of supply, restricted supply, and that kind of margin of impact is very difficult to sort of understand. When someone says, I don't need it, I don't want it, how is it that that's going to benefit them?
Yes, I know your point. That's in my survey there are a very large proportion of the non-bank finance, the MSMEs, do not need bank loans. Yes, actually.
And I just want to add one more. And those micro firms that they normally do not need bank loans, or do not have, or maybe they need, but they cannot afford. So therefore, if you call your paper as a financial inclusion, and this group of people or firms, very small firms, they are the firms that they need to be included, but they are at the moment excluded. So it's not like they are stronger. It's not like they are not facing financial constraints. It is because they probably are not able to afford to, or they have no access to. So therefore, I think you really need to think about why you call this a financial inclusion, and whether or not the indicator, the bank loans can say that much about financial inclusion. So I think this is together with Jaideep's comment on what you are exactly doing here. Is that financial inclusion, or just banking finance, or formal finance? So let's think about that. Jaideep, you have only this one?
I think Juan has raised a hand, so I'll wait, and then if there's more time, I might.
Oh, thank you. So Juan, I see your hands. Come on, please. Yeah. And you are an expert, on smart medium-sized enterprises.
No, I'm definitely not. But it's very interesting to see, from the finance background and also the research. And I think I missed some bit because I joined a bit later. So do forgive me if the question have been already explained. I think it's a very interesting topic, but I totally agree with what Hong and JT just mentioned, because I also had a concern, especially when you explain, there's no need to looking for this kinds of bank loans, then that really a big kinds of pre-assumption there, for those kinds of micro SMEs. is that a certain kind of necessity to make sure they want to have them for them to survive or not? So I think this is something definitely need to be taken into account. I'm also quite interested in the clarification or the categorize of those kinds of data sample in your study, because China is a very interesting context, because even when we look into SMEs, actually those size of SMEs in China are much larger than the others in the market. So it is the same case with the micro, and also it really depends on the different industries. So I'm not quite sure, whether you particularly look into certain kinds of, so to make sure actually that the indicator for measuring the micro enterprises actually consistent and it does make sense. Because if we're talking about retailing and also certain kind of manufacturing, it's a totally different story about how they actually need to get this kind of financing options. I'm also a bit concerned about implications, the policy-wise. I mean, how can we really reach these kinds of conclusions saying that it's very important for the government to regulate? Because the reason why, okay, it sounds a little bit not that optimistic, because the way how micro enterprises or SMEs, how they operate and how they function, even in terms of their financing options, by nature, they're different, inherently different from the large firms or SOEs. So I think it's very important to actually build up your justification about, how the policies actually can really drive, or whether this is really on the priority list, and whether this is exactly what those kinds of micro enterprises are looking for. Because from what I have seen in my, but not really micro enterprises, but this kind of entrepreneurial firm, to be honest, they do not think the government policies matter too much. Okay, that might be quite restrained in high tech or whatsoever, because for them, it's more about their organic growth rather than actually looking for the external institutional support. So I definitely want to know in your data whether you find a different picture or findings. That would be very interesting to know.
Okay, thank you. I would ask Miao, would you like to respond? I actually, do you want to invite your co-authors? You have more experienced co-authors. They are in the room actually. Who is Dr. Bai Ye? Dr. Bai Ye?
Hello.
Would you like to come? Would you like to help? Would you like to help? When you respond to the questions, and also where is I'm looking for the Michalis.
Michalis and Fan, they both are there. So I'm sure they will.
Yeah, Fan is here.
Yeah.
So
I'm sure they will.
Can you respond to Juan's question before we pick up the next one, please?
Sure, I can say a little bit, but I'm sure Miao is quite familiar with her work. So I agree with Juan that I think that's actually the initial idea. We do think the MSME have very different characteristics to the large or state-owned companies. And some of them, I think, according to the data, the sample distribution, we do see that they are discouraged group, as Jadip said. They do need a credit, but it's not like they don't need a credit, but rather they are lack of ideas or opportunities for further investment. I think that could be something quite common and different to those large companies. And I totally agree that we need to dig deeper in that aspect to see, why unique, and what exactly the credit access can help them on those unique aspects to make the story more relevant. We do agree on that. I think we need to look into the survey information to see whether we do have sufficient information from the survey on that aspect. In terms of Jadip's question about the demand or supply side, I think the idea is that because survey, from the end user of the credit rather than survey to the banks, the provider. So probably it's a bit of a assumption to say if you do need a credit and you are able to borrow from the bank, that is using the actual access to the loan to measure whether you have been financially included or financially excluded relative to your needs, right? I think that's the angle we take. So I don't know if if it answers partially to your concern.
I mean, if I can just so maybe it's possible to look into the case, exclude the firms, for example, that say that they do not seek a loan, and maybe then look into whether the others have the kind of because then you talk about exclusion or lack of access. But those who have never sought a loan, not because they don't think they'll get it or any other reason, but they don't have investment opportunities or other factors that you mentioned, then it might be interesting to just at least look at that feature and say, okay, we've got some firms who've got zero demand, and so they're not. Is it an equilibrium condition that they have zero demand because they don't, or they say they don't need it because they're not going to get it, or is it really something different going on here? Because they have alternate sources of finance that are much better for them. In which case, then inclusion becomes a different kind of measure, really. So that's what I was trying to get at, basically.
Agree. Yes, I think we need to define the groups or the subgroups better in a more clear way, especially against what do they really demand the loan, or they just discouraged from borrowing, or they totally really have no need at all. They are different. Yeah, I think a better clarification and a better grouping would be useful. Yeah, thank you. Fan probably have something to say.
Yes,
Fan,
just
yes,
wanna,
please.
yeah,
And
adding
nice to
on
meet you, Dr. Liu.
Nice to meet you. And so I just wanted to add in a bit more on the GDIP's question. We do have the data and the information regarding whether they don't have a loan is because they don't need a loan or because it's costly. We do have that data. So we can do subgroup analysis for this particular angle. So we totally agree with your suggestions, and we'll do that. Thank you.
That's great. And I saw Sandrine. Sandrine, yes, please, Sandrine. Thanks for your patience. So
yes, thank you, Hong. I just wanted to make a comment. I remarked that I have noticed that in your sample, when you were talking about the type of banks giving credit, it was most of the banks were state-owned banks, if I remember.
Yes.
And just maybe it could shed some light on the discussion because maybe those state-owned banks are more open to. They have defined, the condition for loans they have defined is more adapted for small and medium enterprise and micro enterprises. Because when we talk about micro enterprises, there will find more loans with microfinance institution, I think. So I was thinking about these idea as a kind of maybe explanation, but I don't know because I don't know the data, but I was just thinking about that because I think it's one of the specificity of Chinese banking system.
okay, so it's just the comments, right, Sandrine? It's the comments that micro enterprises, they have other sources rather than formal bank loans. For example, they relied on probably more on microfinance. That's what you said, right?
Yes, this is what I'm saying.
Yeah. So thank you. And any comments from the authors or if? Yeah.
Yes, indeed. So basically, the citing in Chinese financial system, is quite unique in terms of there are policies coming to the financial sector in terms of helping micro and small enterprises. And a lot of the undertake banks are those state-owned banks indeed. We don't have as many microfinance institutions compared with other countries global-wise. The majority of the micro credit are actually going through state-owned banks as well as those fintech or digital finance companies.
So
that's,
excuse
yeah.
me, just to add to the discussion, maybe it's because, I mean, it may be an explanation of one of your results because you mentioned that the policy were not very successful with micro enterprises. Because if you have more state-owned banks and they are more, how can I say, they are more adapted to make loans to small and medium enterprises, it means that at the end of the day, this can explain the fact that in your survey, micro enterprises answer that they don't need a loan because it is as if the financial system could be not very adapted. But it's just hypothesis I'm making because I don't know very well the Chinese banking system. But when you were presenting the descriptive statistic, there were some questions I was asking. For example, when you presented the access finance, let me. Yes, when you presented your descriptive statistic, you didn't differentiate between micro enterprise and small and medium enterprises, and I was wondering if there were not you didn't add in your data information about the fact that micro enterprises had more access to informal funding. Do you get what I'm saying? Because
yes.
as they are micro enterprises, I think that they will have more access to informal finance than formal finance. So maybe you should also look at those information if you have them in your survey. Thank you.
Yeah, I think that was covered by the presentation. Yes, indeed. Microfinance, they have more, informal finance have a positive impact on them, but not state bank loans. So that's basically one of the a lot of results. So, so I think, do you have any, Miao, do you have any other responses?
I just want to say to Sandra, yeah, I think you have a very good point that in my descriptive statistics, I needed to split the SMEs and micro enterprises and show whether micro enterprises have indeed have higher informal financing instead of formal financing.
Yeah.
Thank you.
Yeah. But if I could add one thing, just one thing to reply to Sandrine's comments. I think we have other paper that we do see what she commented on in terms of the policy implication. It's not just having access to loan would be adequate. I think there are a lot of soft support, let's say, like supporting the training and providing the adequate institutional support and arrangement would be very important for the SMEs and also rural households to be able to adequately or efficiently use those loans. So it's not just about giving money. It's about give them enough training and provide sufficient information, that sort of thing. So that's why part of the study, part of the thing we look at the location. So the infrastructure, having a high-speed railway or not nearby, that matters. So I think Sandrine does have a point there. It's what else other than the loan would help? Yeah. So it's quite right. Yeah. Thank you.
Yeah, great. So Jeffrey, I saw your hands. Jeffrey is the next one. Jeffrey is our postdoc in the center. Yes, Jeffrey.
Hello. Thank you. I just wanted to say something about the size of the paper. I think it's quite huge. I think you have expanded the paper so much that it's almost unclear what the focus is. For example, like in line with what Jadip said, I struggle to understand the way you use inclusion and access. You define your access from the usage perspective, and your evidence is showing that you have a group of discouraged borrowers. So, which means in a way, not necessarily because the finance is not there. So my recommendation is for you to look at recent literature that they are changing the way they define access. They now use cost. Because when you look at your analysis, I think is the reason these borrowers are discouraged because formal credit may be too expensive, either in terms of interest or the use of collateral. Because usage was the initial definition, but because cost is very important as well. And in your analysis, I think you've also provided some answers to this question, if I can put it that way, because you show that the use of formal credit is associated with less returns or performance. So that sort of tells you there's something wrong with terms of cost and the use of formal credit. That is the reason that your borrowers are discouraged. That's my point. So you might need to sort of look at your definition of access from the cost or supply perspective. Thank you.
Thank you very much. Yeah.
Yeah. Okay. So any other? Thanks, Jeffrey. That's very good comments. And any other? Maybe I can now raise two. Okay, Jadip, yeah, after me. So I have two questions. As I also feel the paper is huge, and then you basically you did quite a lot of different tests. I want to see a little bit more focus. So what is the key message that the paper is going to send out? So that's one comment. And actually related to that, you mentioned quite a lot of theories. You mentioned asymmetric information, signaling, you mentioned the law of diminishing return of something, and you also mentioned something else. So I actually, if you think about your result, I think the key underlying theory should be related to the asymmetric information, because you basically talked about your results focusing on whether or not they are facing more financial constraints. Yeah.
Yes.
So the general conclusion is if whatever you are talking about, if they create more problems for those firms and the firms are facing more financial constraints, then you see the result. Okay. So therefore, I would say you put other marginal or relatively less important theories underneath, and you emphasize the central theoretical framework. I agree, financial constraints theory should be the fundamental underlying theory. And also related to the second comment, my next one is you checked, one of the selling points of your paper is the firm attributes. So you looked at different interactions between firm characteristic, any specific firm characteristic, and the, let's say, the access to formal financing, and you see different results. So my question on this is, what is the rationale? So how do you justify that you selected those firm attributes and not others? Do you have a clear or a line that you have followed? So you selected the location, you selected the high-speed proximity to high-speed railway station, you selected the owner's education background, and then the regional development. I see some overlapping here, but I see more. So if you think about a firm, like if I'm a small firm, I'm operating within my own firm that's internal, but then external that has quite a lot of elements. So what you selected here are the external elements, which is reasonable because you want to check the external financing thing. So I want to see a clearer justification or more explicit justification of selecting those firm attributes or the environmental factors, and to motivate your hypothesis a little bit more. Okay, so that's my comment for the moment. Can somebody respond? Why did you select those attributes? Because I'm very interested in knowing this. And why did you select them randomly as a moderating factor, or do you have any underlying rationale behind this selection?
Actually, I selected the indicators from 3 dimensions. That is the firm's dimension, owner's dimension, and the more macro, the province dimension. And I actually, the most interesting indicator is related to the firm's dimension, because they are mostly the Chinese unique characteristics. Because for example, the first 2, the location and the high-tech attributes, because this is in recent years, Chinese government do have a lot of financial inclusion policies to help those rural firms and the high-tech firms to access bank finance. So this government intervention really motivates us to explore this moderating effect. And the other, the high-speed rail, because also high-speed rail is very high-speed rail. China is known as the most advanced country to have the high-speed rail. So I want to see their I want to see the moderating effect related to high-speed railways, the distance to the high-speed railway station, and also the listing status, because China's multi-tier financial market, the user board is very the user board is China's unique financial market for SMEs financing in China. So I want to see whether the of listed SMEs and the unlisted MSMEs have different impact with respect to financial inclusion. So I choose those indicators because they are more China's unique.
Okay, I guess you have very small amount of listed firms in your sample, right?
Yes.
You may have very small number. But yes, that makes sense. But maybe I didn't hear you when you did your presentation, giving the time. And so in terms of you emphasized quite a lot about Chinese government policy encourages to include the small and medium-sized enterprise, etc., etc. I didn't see anything in your empirical analysis. I didn't see your variable in your model. So I wouldn't say, because think about what you interpreted quite a few times. If the banking law works, you say this is because the Chinese government encourage banks to promote, to include vulnerable firms. But as a bank, the first objective, the priority for them is to get a higher return. So I did not see that policy element. So if you really want to see to emphasize this policy, you either add a policy dummy or a policy or something, or you do a DID or something, but you need to explicitly do that to be able to support your statement. So that's my initial. I heard somebody wanted to respond, right?
Thank you, Hong. Probably not to this last comment. I do agree that I think we know in terms of state-owned banks in China, they have this, you can say, so-called social responsibility to really promote the financial inclusion policy of the government. So that's kind of embedded in their lending decision. But you're right, in terms of empirical setting, we could tease out more with more explicit indicators or specific policy change. That certainly would be a very valid point. What I was going to say was that Miao mentioned her choice of those firm characteristics. It's not just because it's China unique or relevant to China sample, but actually all of them have a very well-established literature related to those characteristics already in terms of how they can promote to, let's say, poverty reduction and promote the firm access to better market and the information. For example, the infrastructure, including high-speed rail. So it's not just because of Miao's personal choice. So there is a literature to base on. That's one thing. Another thing, I agree with all of you saying there are so much here going on, seems losing focus. It's actually because Miao is not presenting a paper, rather than Miao is presenting 2 chapters here. That's why she has the 3 chapters, and the 3rd one was about rural land certification. But her first 2 chapters are all about SME. So we've been greedy. We would like to get comments. So she has been squeezing in too many things from both chapters here. That's why it sounds just too busy. Yeah, this is the reason. Okay. But when we actually write into a paper, we totally agree that we need to focus on a much narrower aspect to have a focus. Yeah. So just want to add that. Yeah, thank you.
Great, good to know. That's why I said Miao worked so hard, so gave us quite a lot. Sometimes it's difficult to digest and to. Good luck with that. So JD, you have some other comments or questions?
Yeah, I was just thinking about a couple of things, sort of like one was related to what Hong said, which seems to be, I mean, it doesn't seem to be very central to the work. So I'm not sure how valuable it is as well, which is the listing versus unlisting, listed versus unlisted firms, because it doesn't seem to necessarily add any new information, but at the same time, it raises a lot of questions about how many micro enterprises are going to be listed. Where is the distinction here? Is the group so which is it genuinely a split down the middle in a sense of what firms are listed and unlisted, which ones are more likely to be listed, and so on. So there's a kind of a selection element there. So it seems that may not necessarily be an additional exercise that's sort of it'll need more justification really than it's worth in a sense. So that's one of the things I wanted to say. The other thing was it's just a thought actually, so it's a little bit out of scope of what you've already presented, but it's just something that maybe you have the ability to do. So I thought I might suggest it. There's this kind of financial inclusion when you talk about it, is that there's another channel to financial inclusion, right? So Miao, in your presentation in the beginning, you started talking about internet and digital finance. And I was starting to think that, okay, that's a big thing. And there's a big opportunity in China because I know that there was like a sudden crackdown at one point, and there was a massive reduction in fintech enabled consumer finance. Now, consumer finance is obviously financing purchases of products. So essentially, it's kind of in a way supporting the small enterprises that sell on these platforms. So there's a different dimension, like a channel of the retail finance that affects the sales of firms. And there was a point at which there was a kind of a break. So I'm kind of interested if you've thought about that, if you think you can do something with the financial inclusion of the consumer as opposed to this industry, and maybe there's something you can explore there, maybe in another paper. But since you have the data,
Yeah. Any?
Miao, are you going to say something? Okay, I can add a little bit before Miao probably can answer. So, Jadip, we totally agree on this retail, online retailer part, because we know that in China now pretty much the physical stores almost hardly there's any business really. Most time we do shopping really is online because it is that popular and common. I think at one point, at a very early stage, we did talk about this with Miao, but it was to do with how to get access to those online retailer and actually get them to do the survey. That was a bit of challenge because they're not physically there and it's difficult to get in touch with them. I think that was the impression. But we did talk about this this idea because they are typical MSMEs, and they really lived on this digital platform. So you're totally right on that. Another thing, yes, about this listed on the unlisted part, I think the main idea here why we included was more about information symmetry theory, as Hong pointed out. That's quite relevant, right? So if you are listed, then surely you get more access to capital, and you face less information symmetry. And in particular, in the recent years, China, the stock market in China had a reform. We have this particular board which targeting at small medium enterprise for them to be listed. So it was a major change in the Chinese stock market. But for our purpose, the pity is that in our sample, those listed firms sample are too small. Otherwise, this can be actually a separate story with its own merit, really. But this was the reason why we included. Yeah. So totally agree with you. The sample was too small to tell something significant there. Yeah. Miao, maybe you have something more to add.
About the online retailer, yes, the retail financing is very. I think it's very popular, especially for the online retailer, and the online shop is very become widely used in China now. But because we collect the survey data with the help of the survey company, and actually they cannot send the survey to those online retailers. They can only send survey to the registered physical stores.
Yeah, and now so I think in terms of the data, that's something that I'm very interested in. So I think you did your own survey, which is very good. But on the other hand, people will ask quite a lot of questions as well, because you did your own survey. So how convincing is this that you guarantee us to trust the data? So can you talk a little bit more? So I think this is for your next step. When you publish, when you submit, and people will ask this question. So it is not official survey data. So you designed and you did that through maybe a business or something. But how do you justify that your data is convincing, is trustworthy, and is representative?
Actually, when we collect the data, we use a lot of cross-section questions to cross-check their answers. If the cross-section questions help us to rule out the some obviously wrong answers, and those are regarded as the invalid response, so we delete them. And the remaining survey data is a valid one because they pass all our cross-check questions. This is about the validity. I think.
What about the sample selection?
Sample selection, the representative.
Yeah. So why did you select those firms? And so what is the? So I think you mentioned it. Did you mention something? Systematic sampling. Did you mention that?
Yes, stratified random sampling method.
Yeah, stratified. So how did you? So what is the regional coverage?
The whole country. It covers
the whole country.
29 provinces.
Then stratified, then that means you have to first of all to divide, right? Divide into different
regions.
Okay.
The West, Central, and Eastern China divide.
Okay. Yeah. And then you randomly select.
Yes.
Or proportionally select. Yeah, great. So I think those things maybe I'm sure you did a very careful work in your writing, but I didn't hear that much. So that's why I was thinking about it. So and you do have some statistical theory underneath. So I think that's okay. Any other questions? It's a very interesting topic, and Miao has presented 2 chapters. So any other questions from the audience, from colleagues? No? Okay. And so I would say I enjoyed very much, and not only because this is so much related to my research area, but also I think you guys have done a very good, well-rounded work. Although we did have some comments, and this is the way that we move forward for our publications or research, let's say. And so do you give you 1 minute maybe? Who is going to, I think maybe the PhD candidate or the supervisor or supervisors? Do you have anything to? Yes.
Miao, would you like to say something since you are the presenter?
Yeah. No.
Okay.
Right. Okay. All I would like to say is I just to say big thanks to Meng and to Hong for organizing the seminar. It has been very well attended and always have very interesting topics ever since Victor been chairing the seminar. So we really appreciate that Miao gets this opportunity to discuss her 2 chapters before her Viva and getting very, useful comments and feedback, not only just for the chapter, but also later on when writes as a journal paper, how it can be told, the story. I think those are all very valid and useful comments. We really appreciate that. Thank you all very much, all very well taken. And now we can see there are various work we need to do before the Viva, or something can be left after the Viva. Yes, and hopefully when there are new things being developed, or maybe there's an opportunity in the future on her 3rd chapter, which is on a rural land certification versus in the context of financial inclusion, we would hope there will be opportunity to come back as well. So thoroughly enjoying the discussion. Thank you all very much. Thank you for everybody who raised the question. Thank you.
Yeah, so thank you so much for your contribution.